For my bar mitzvah, my cousin, who was always a little bit, he got me a pair of Larry Bird game-worn sneakers that were signed by him. They were like the old black Converse.
Right.
And I was super psyched until I realized they were a size 10. And I was like, Larry Bird's a big dude. I don't think he wore a size 10.
Yeah.
He's like, these are game-worn. I'm like, dude, don't bullshit a bullshitter.
Yeah.
The signature looked real, but I don't even buy that.
Big Bird fan, but I agree with you. The guy was 6 feet.
Size 10? I don't think so. I'm a size 12
Yeah.
and a half.
Do I putting these on?
Where are my muffs?
These would be good for outside today.
Yeah.
I might have you slide down just a little bit so you're closer to the mic.
Okay. Rocking the mic.
So are you following the Nelson Peltz versus Disney stuff at all?
Not really.
So Disney put out a formal filing
17? Yeah, exactly.
basically saying this guy Nelson Peltz has met with us 30 times. He never says anything. I think like he just wants a board seat.
He's an ideas guy.
No, but he isn't. That's the thing. His idea is give me a board seat. Like that's his. In other words, he's not putting forth any strategy or any competing idea for Disney. It's just like give me my board seat already. And I don't know. So they formally rebuffed him. So he went on TV today. He went on CNBC, and he's not going away. So they're gonna have the proxy vote this spring. It's gonna be a lot of fun.
The stock is looking less terrible. Stop going down for now.
He has the former CFO from Disney as one. He wants 2 board seats. I think one for him and one for this guy who is the CFO. And that's like their demand. And he doesn't own enough stock himself. He has the guy that sold Marvel to Disney, Ike Perlmutter. He has that guy's shares. And that guy has a lot of stock. So it's gonna be a fun one.
You have any experience with these guys? You ever deal with them back in your day?
We do a lot of work now for corporates and law firms and boards when there's an activist situation. Mostly it's about some capital use, like should they do an accelerated share repurchase? Should they do a spin co? Often the activist wants no spending. So if you're a healthcare company, you either have to do R&D for a new product or SG&A to market what you have. If you do nothing, sure, you can print 2 good quarters on margins, but then the business is probably starved going forward. So often what we'll do is just come in and say, okay, here's a group of stocks historically that looked like this one. How did they toggle their R&D spend or their marketing spend, and which ones had a better, EV to sales or whatever. So we just kind of give them the empirical data to give them advice about what to do.
They want to know which stock went up, which one had the stock price that went up the most?
Yeah, which was like the better spending path to generate value.
I was reading your spinoff work. That was good stuff.
Oh, thank you.
Yeah.
You're the one. I saw one guy clicked on it.
Who brings you in, the company or the investment bank that wants them to do something because they'll get paid for doing it?
Yes.
Both. Okay.
Yeah, law firms, boards, friends on boards, CFOs, IR. And then we can be proactive. Like if we know there's an activist that's gone in, we can go to the corporate if they want help, or even we work with some of the activists too. For us, like I don't want to say I don't care, but it's clinical. Like here's the data, here's what it shows. Is there a distribution of outcomes?
You're like a court witness.
So you're not giving necessarily opinions, you're giving data?
I give my judgment afterward, but it's supported by the data, right?
You're not a court witness is hired by one side or the other, but so are you.
Yeah, I'm not. Yeah, but I'm not like involved in the same thing on both sides or anything. It's just sort of like, okay, there's an activist. There's a remain co and a spin co. The remain co's got the activist, and that activist wants no spending. So the board of the remain co will hire us to sort of give them the evidence of what to do.
I don't know why. I just thought, the scene in My Cousin Vinny, ladies and gentlemen of the jury.
Yeah.
All right. So they'll bring you in and say, okay, forget about the opinion on the right strategy. Give us the numbers.
If you're
what would be the right thing to do by the numbers?
If you're paying $15 million to one of the big investment banks for a divestiture fee and $4 million in legal fees to one of the 5 firms that dominate that, for me to charge a fraction of those numbers and empirically give you the data that supports doing something, I'm a really small percentage of the bill of material. So the advisory business for us is great. If your combined legal plus IB is $18 million and I charge $100,000 for the expert analysis, is great business for me, but it's such a small percentage of the bill of materials for the deal, and it helps them get confidence that I'm not maybe biased data from the investment bank giving advice, or I have an agenda to get the transaction
Adam,
done.
when you
or whatever.
explain that date, when you explain that business,
Is
to
this
me,
for salad
What's the
or
deal-
what is
what's
it?
the deal with this?
Are we having some
it gives
snacks or what's
it,
going-
it
It's
gives,
depth?
It
What is
gives
this?
the table dimension and depth. You can't have a YouTube video where a third of the screen is a brown table.
Okay.
Okay.
So
Okay, Michelangelo.
I thought it was related to how fat I was looking at from
when
this angle or
you
something.
also we're gonna fill it with wings.
In GLP-1, this you won't need this after we're all on Ozempic.
So it gives the table depth, and we're gonna fill it with lemon pepper wings
Yeah,
from
right, I like that.
Wingstop.
Yeah.
So when you
Fries.
told me that business that you were in, what
Right.
did I say? I said stop doing everything else. Be the quant be the advisory quant.
Right.
Because I don't think that exists. How many guys like you are running around who can do those research reports with the credibility you have to give corporate boards direction? Not a lot.
Yeah, I think the two things that we're doing that we're trying to amplify my background are one, risk work. So we've signed dozens and dozens of non-disclosure agreements with buy-side firms, long-only hedge funds, quants, whatever, who send us their portfolio to do custom risk work. So a lot of institutional investors will have services that do the risk, Barra, Axioma, Morgan Stanley Fund Services, if they prime broker, whatever. And so they pay us to kind of come in and say, okay, what do you see as the real risks? We can be more nimble because
They're taking existing portfolio
Send
and
it to
they're
us,
saying,
yeah.
Parker, where are my
think,
risks?
Yeah, what do you think the risks are?
Okay.
And
Also
so we do,
great business.
Yeah, so that's a great business because if you're the CIO of the fund, like maybe if I work for you, I'm a little bit nervous to kind of like really slap you with what I think the risks are, but they're kind of paying me to
You're
be
objective.
Yeah, I want you to do well.
Oh, that's
and
interesting.
They want you to find
Yeah,
risk.
yeah.
The analyst that works there doesn't want to rock the boat, but you're like,
Depends on the
hey, you
culture of the
paid me,
firm,
so
but-
here's what I think.
Yeah, it depends on the culture of the firm, but I'd say
Yeah.
in general, I my only goal is to help, and so I can say, look, this is what I see. I can think if rates rise, you're going to get killed, or all else equal, this is the thing that hurts you, or these are the because sometimes it happens culturally, Josh. Like let's say you decide you run a big fund, and you're like, you know what, I want to lighten our tech exposure. I'm a little worried about it, right?
I say that every day.
You go to the tech PM, and you say, give me your at least 3 favorite names. Because you don't want to, sort of disenfranchise the person who's been working hard picking the stocks. The problem is those 3 least favorite names might not be the 3
Where the
least
real risk
risky,
is.
right?
Yeah,
and so it helps to be like, okay, great. Culturally, you told them to sell that, but if this happens, FWONK is going to get killed, or whatever name is in the fund that's got the risk. So we do it more like on a risk. How do you sort of maybe best implement what your concerns are?
Right, because sometimes maybe it's position size, sometimes it's leverage, sometimes it's not the name itself,
Yeah.
but the way that you're trading it.
or replicability, not to get too nerdy this early, but like maybe there's a stock that has 70 other names that trade just like it. And so I don't need to own a huge position in that because I can spread the risk across a lot of other names.
Right.
Or maybe it's like there's nothing like it, and then I better be right, or there's outsized risk per unit of capital.
We're gonna get into that today, and John looks like he's ready to go. We're ready to go.
Get it going.
All right.
Oh, that was all warm up. I like it. Okay. I didn't even know.
Just getting the blood flowing.
I always have an on button. There's no.
Today's show is sponsored by Jensen Investment Management.
Josh, I like my investments like I like my cars.
Go on.
Quality.
Oh, I would agree with that. Jensen has been a quality-focused equity shop in Oregon for the last 35 years.
I do love Oregon.
Well, we all do. But what's important about Jensen is this. They're not looking for short-term return chasers. They are looking for investors.
Count me out.
Okay. They are looking for investors who are seeking long-term risk-adjusted returns. There are periods of time where quality is in favor and periods of time where it's out of favor. They don't chase low-quality stocks in 2021. They stick to what they do. They're disciplined.
I'm a quality guy.
Okay. Jensen runs 3 strategies: U.S. large cap quality, U.S. mid cap quality value, and global large cap quality.
Quality is quality. And if you know, you know. And if you want to learn more, you go to Jensen with a J, investment.com. That's jenseninvestment.com.
126, what's up? So excited to be here today. Ladies and gentlemen, welcome to the Compound and Friends, the absolute best investing podcast in America, according to my sources. My source is Nicole. You agree with that? Yes? Hell yeah, dude. All right. We're going to have an amazing show. To my right, I guess you're to my right if I'm leaning this way. Adam Parker is the founder and CEO of Trivariate Research, a U.S. equity-focused boutique research platform. Adam was the chief U.S. equity strategist at Morgan Stanley from 2010 to 2017. Well done. And is a frequent contributor to CNBC. Adam, welcome to the show.
Thanks.
What was the order of Morgan Stanley chief strategist? Who was before you and who was after you?
Mike Wilson, the current strategist, is the one
Came in right after you.
Came in right after me.
Tom Lee was J.P. Morgan.
Right.
Who was before you at Morgan Stanley?
Briefly, the well-known person was Henry McVeigh.
Okay.
Henry works at KKR and
Okay.
should be on your show if you can get him.
Okay, call him for us on your way out of here.
I will.
Okay,
Yeah.
and with Adam and I, our son, Michael Batnick.
Oh, come on. Get lost.
I mean, a little bit son vibes. Adam, I've been dying to ask you, really since before the year began. We haven't heard from you in a while.
Right.
I catch your appearances on TV. They don't give you enough time. I don't give anyone really enough time. That's TV.
Right.
What is going to happen this year? Last year, I think it's fair to say a majority of people who follow the economy and the stock market for a living were just completely shocked. Like we could all kind of agree. All right, so we get over the shock, and now we're in a situation where inflation is falling, earnings are growing. Can that continue? Did we just like get out of jail free card, assuming the Fed doesn't make another mistake?
I think the skew is to the positive for this year.
So it's a yes.
I do.
Okay.
I could tell you because we just did our outlook a couple weeks ago. I don't understand why the big bulge bracket firms do theirs in November and then they already are wrong before January 1st. I don't want to have to change my view of the year before the year starts. So we do it early in the year. We see what the consensus is out there, and then you can sort of see. I hate romanticizing. I'm contrarian. Like, you got to actually know what the consensus is and then figure out if you're different or not. And some things you are, some you aren't. I think the positives would be, one, I think the average company can probably have gross margin expansion. Okay. And if you believe that, you should probably, on average, be bullish. I can walk through, a semester on why, but
is that simply their input prices are coming down and they're not lowering their prices?
Yeah, I mean, that's definitely one of the 4 or 5 reasons. I mean, look, costs are wages, their materials, and their depreciation, and none of those things are getting worse. And so the pricing and mix would be the other side of it. And I think, the costs are going to turn from headwinds into less headwinds or tailwinds for the average company.
Chipotle is a great example. So we learned that food at home, grocery store stuff, it's coming down.
Right.
I went to Chipotle before. Those prices aren't coming down at all.
A lot of companies are going to be able to maintain the prices, and so that should be good. And you've already seen over the last 6 months, so the median stocks gross margins kind of plateau, and the analysts are forecasting a decent number of them will have gross margin expansion. I think about 70% are supposed to have gross margin expansion. Now, analysts aren't great at calibrating. We all know that, but they're pretty good at knowing whether margins are up or down. I think they're right like 3/4 of the time. So I think, we'll see with logistics costs and some geopolitical stuff, but I think costs can come down. So
let me ask you.
So that's one of the 3 points on why I think, the market could go up, is that gross margins could go up for the average company.
Let me ask you how good you feel about costs coming down, though, because before we leave that to the next two.
Yeah.
Because if I give you that the labor market is loosening somewhat, maybe not every industry, but just like generally. All right, I'll give you that. Energy costs have been okay. I'll give you that. Food costs, whatever, whatever your inputs are. Insurance, reinsurance. I mean, the rates at which business insurance, property and casualty, every type of insurance you could think of.
Healthcare costs.
It's worse than 2021.
Yeah.
Healthcare costs, I was also going to throw out.
Yeah.
So there are still costs that are rising way too quickly, and these are important costs for businesses.
I think that's true. I mean, but it depends on the business, and that's why I was kind of parse my words with the average or median company can have gross margin expansion. I don't think it's all of them. I just think it depends on your costs and your margins. But for most businesses, take like a industrial or a machinery or semiconductor, whatever, their COGS are depreciation, materials, and labor. And I think, like you said, Bloomberg Commodity Index, or how you think about materials, generally it should be better. Currency could help if they're international. Labor, wages are inflating less, productivity is growing.
What about borrowing?
And so that the borrowing issue affects, lower quality balance sheet small caps on a relative basis, and that's why they ripped when financial conditions eased in November, December. They probably won't incrementally ease, and so it's less. Maybe I think what you got there was multiple expansion. Now you need to see the earnings side come through to merit. Those
You don't have to worry about borrowing costs for the S&P 100. It's not a huge.
This will
swing
be
factor.
a dismissive statement that I'm sure there'll be some comment on, but like
We'll save the video
S&P
clip of it.
500 companies don't really go bankrupt. Okay.
Yeah.
I mean, obviously, that's one or two can happen in a crisis. You had 3 banks last year, but like in general, they don't. So you're really talking more about stocks 1,000, 1,500, where they're wax higher and it hurts them when rates rise. But it definitely doesn't affect United Health.
Let me clean that up for you.
Yeah.
They do go bankrupt, but long after they've ceased being large caps.
Yeah, they've exited.
Sears was not in the S&P 500 for a long time,
Right.
before it became what it became.
Totally, and by the way, that's one of the reasons it's kind of hard to beat the S&P is they kick out inferior companies and add good ones, and so it's
creative
a managed
destruction at its finest.
index. Yeah.
So Adam, I want to go.
So you're giving me the right pushback on the gross margin point. Like, sure, if your cost of capital goes up and you have a lot of interest expense,
Well, what are the other two? All right, so we got that. What are the other two reasons?
So one is margins. Two is, and this is always hard to see, but like longer term investors who do like cross asset are always bearish on equities because I think earnings could grow 5, 6, 7, 8 years in a row. I think there's a chance that you'll be sitting here in the middle of the year thinking they're probably higher in 25, and then in 25 you're like, yeah, they're probably higher in 26. And so just like in 2011 when they grew to 2019, like if there's no reason why earnings are going to collapse for the next 5, 6 years, equities are of course going to be better than owning bonds over that period, right? So that's, if you start getting confidence that earnings have kind of troughed and could grow in a lot of areas, that could also be bullish. It's hard to forecast out in the future, but I don't see any reason. Look, this cycle is different than when. The third reason is generally you're going to get front-end accommodation, whether it's as much as in the price or not. The Fed, the BOE, and the ECB are all saying they're probably going to cut. So I think if you and I have learned one thing in the last 50 years of collective analyzing things, fighting the Fed is not a particularly good idea. So like this bull case very simply
It was last year.
Huh?
Fighting the Fed was a good strategy last year.
It was?
Yeah. They were trying to slow the economy or slow the market. It didn't work.
I meant hiking rates.
I meant fighting the accommodation, not the tightening. Yeah. But so I think the simple case would just be margins are going to go up for a lot of companies. Earnings will probably grow for a while, and the Fed's probably likely to be accommodative, and that cocktail could be good. I think the harsh pushback would be one, China looks directionally bad and getting worse, and so economically sensitive business there could be bad. Two,
Valuation.
Well, you got quantitative tightening on the balance sheet, not on the front end, and maybe that is a liquidity problem. Three, I think the U.S. consumer, is slowing.
How about 4? That's consensus. The market was up 26% last year because the market is expecting these rate cuts in the soft landing. And if you don't get one or two of those things or less good than expected, then maybe we give some back.
I hear you. I don't think you can show that empirically as well. There's plenty of years where the market goes up a lot after it went up a lot.
Totally. All right.
So I think that one is harder. It resonates with me. I think with everybody. And this is like I don't mean this to sound, well, that's why maybe the first 3 days of the year it was bad. You know what I mean? Like everyone knows it ripped for no reason in November. But like if I look out 6 or 12 months, I have less data to support that. I get it. It resonates, but I'm not sure I would go back and look at 95 years of S&P returns and say every time it was up above 10, I sell it the next year. You know what I mean? So that's
not my argument. That's just what people would say.
No,
okay.
I agree.
So, Adam,
and it could be right, by the way. It's like you never.
We'll find out. Right. We pulled a bunch of your charts from that awesome paper that you put up. No, let's just use this as a jumping off point.
Okay.
So you wrote a bottoming economic activity gauge and loosening financial conditions are typically positive for risk taking. So you've got 2 charts.
Yeah.
This is Trivarius proprietary economic activity gauge.
Yes.
And you show when it's increasing, when it's decreasing, and when it's sort of without trend. And this is it's sort of in no man's land, but it troughed, right?
Yeah.
What's in here?
So what we do is we download about 170 variables from Bloomberg, and we create a bunch of gauges. These are 2 that I thought looked directionally positive. Economic activity is stuff like city surprise, leading economic indicator, small business optimism.
And that was going down all of last year while the market was ripping.
Correct. And the reason I do this is twofold. One, to try to have sort of an unbiased gauge of what's happening. I've learned when you're on the buy side, what you realize is you don't know when the trough is at the trough. It's very easy to go back and tell you what worked from the trough to the peak 20 years ago. I can analyze that. But when I'm in the trough, I don't know what it is.
Yeah.
And you, if you're being honest, and what I've learned is it takes about 6 weeks. I'm about 6 weeks. I'll tell you 6 weeks after the trough when the trough was, and 6 weeks after the peak when the peak was.
So if all you could do.
So if you're going to implement a strategy, you have to be honest when you run money like you guys and say, all right, I'm going to be late implementing it, and I'm going to ride it over the edge, and net still has to add value. Otherwise, it's stupid and I shouldn't do it. It just creates churn or whatever. So one reason is honestly where I am. And the two is, I think you guys know this, but we build like quant models to predict stock return, and we always advise like long these and short those. And some regimes, the models work great. So like with financial conditions on the right, when they're easing, I cannot pick banks winners from losers at all. Why? Because the bad ones do better than the good ones.
So it's one trade.
But when it's tightening, I want to take my gross exposure up and be long and short a bunch because the model works great. It's really able to separate winners from losers. So I can use this as a gauge for, when I should increase my gross exposure, to use that vernacular. So for the people listening, like net means am I long or short the whole industry? Gross means am I picking winners from losers, market neutral? The model works great picking winners, market from neutral when financial conditions are tightening. So I want to measure that and then implement that as a gross exposure advice. So there's a couple reasons that I do it. There's probably 15 signals in each one. I don't have off the top of my head memorized.
In this first chart, though, what's obvious to me is that there aren't any real false, like every one of these rallies in economic activity, they don't roll over after bottoming. They persist for a little while.
Yep.
And that's probably because the economy itself doesn't turn on a dime all that easily or very often.
But financial conditions do.
And I didn't want to create a signal where I was calling my biggest investors who are long-term
Every month
investors
with
and
a
be like,
different story.
hey, it got worse this month. Hey, it got better than,
Okay.
So it had to show like confirmation. Like if it's a weekly signal, for me to change it, I think it has to be like 15 to 20 last weeks. It had the same direct, it had to show some persistence because otherwise, a friend of mine who explained this to me, he's like, you're walking your dog around Central Park and your dog's going to chase butterflies and piss on trees or whatever. And when I ask you where you are, I don't mean like where the dog is. I mean, like, are you on like Central Park South or
you
Fifth
want
Avenue?
confirmation.
Yeah, like,
You want
where
confirmation.
am I, like holistically, not like every
So the
little
guy
perturbation.
the guy that invented that that metaphor that's the economy versus the stock market.
Yeah.
The guy walking the dog is the economy.
High frequency
The dog
data
is the
point
stock market.
economist. Right,
So
right.
that guy was a mutual fund manager, Ralph. I want to say Ralph Wagner.
Okay.
And I think he had a career,
Right.
He wrote me a letter because I used that analogy on TV.
Nice.
And he goes, I really appreciate using the analogy.
But
And I don't know. I don't want any credit, but I want you to know where it came from.
That's pretty
And he
cool.
sent me the column, and I think he wrote the column is from like the 90s.
That's pretty awesome.
I gotta go. I might be using
I
his
don't
last
get
name
nice.
wrong.
I don't get nice letters. I only get like you pronounce this word
let me-
wrong
let me-
with your
let-
Boston accent or whatever I get.
Let me say one thing though. I don't get my own letters. They are filtered before they're given to me.
Oh my
pure-
God.
So you couldn't
Oh,
even fucking
curated
imagine what's
letters.
coming in.
what a diva.
Yeah.
I said like some word that I had no business trying to pronounce on TV wrong. I can't remember if it was ebullient and I said it ebullient or what it was. And this guy acted like I was, I was like post,
how dare you.
The horseshoe scar on my head. He like really crushed me.
John, can we throw the chart back up?
Lobotomy, post lobotomy. Yeah.
So what's interesting is that economic conditions were contracting for, the Fed did what they had to do. Economic conditions were contracting. But when that bottomed, look how quickly financial conditions loosened. Do you think that a lot of the loosening that the Fed was going to do has already been done for them, and then maybe they're going to be less likely to cut however many times it's priced into the market?
So one, my track record for calling the Fed is poor. Two, the firms I've worked at, their track record is incredibly poor. Three, I don't understand why they do stuff like buy mortgage-backed securities when the housing market's on fire in every MSA in America. So I don't know.
So stipulate, we're all guessing.
But that and
The Fed doesn't know what they're going to
they
do
don't know
either.
either. They
and
don't
I
know
don't
either.
do that for a living. And if you search my website for the word Powell, it says 0 search results. Given that mountain of
That being
caveats,
said-
I don't think they can cut 6 or 7 times before January 25 or whatever's in the price, because what I think I learned is that you need full employment and stable pricing. And I don't think the unemployment data are going to deteriorate at a rate that's going to merit that much accommodation on the front end. And I think if I'm right directionally and it's 2 or 3 or less, I think it's because history is not helpful. The last 3 cycles were TMT crisis, global financial crisis, and COVID. This is not yet
I totally agree with that.
anywhere in one of those things. Yeah.
So now you could take those 3, you could create composites.
Yeah, average
What are you
them
doing?
in,
Looks nothing like
and
this.
You know what that
yeah,
is? That's
right.
like when a little kid, you give them a paint set and their first day of finger painting or whatever it is, it's every color mixed together. It's just mud. There's no information.
When you do
there.
a lot, we do a lot of like data analysis, and like sometimes you have variables where like, it's a 1 if something happens and it's a 0 if it doesn't. And then you tell people the answer is 0.5. Like you tell them it's something that could never actually happen, right? I think that's a little bit of the problem of like using these 3 things and saying they're relevant. And that's what every quant struggles with is like what historical time frame and regime are relevant for you to analyze. And therefore, if the future
There's no
pans
analog
out,
for this.
and
There's no analog
that's
for
why
this.
I don't
One thing,
think, so there's a
though.
lot why I don't think they're going to cut as much as what's in the price.
You have the bulls saying we're going to get 7 rate cuts this year.
I don't think that's bullish. I think that's bearish because
Time out.
things
Of
have
course.
to tank.
Why
Yeah,
are they Why are they cutting rates 7 times? Are you serious? Okay, fine, but whatever. That's the bulls are saying
Right.
the Fed's getting easier. Okay, fine. Then you get a CPI that's a little bit hotter than expected. Okay, it's not 7, it's 6.
Right.
Okay, then you get a retail sales number that's 0.6.
Right.
That's way hotter than expected. They say, okay, it's still 6 cuts, but they're not going to do the first one till May. Okay, they're going to go May, and then every single meeting after that, and you know this how. So why even play that game?
So look, one of the dumbest things that I accidentally started when I worked at Morgan Stanley was the phrase "bad is good." Okay, and when you sit there and you have the biggest firm, it gets distributed. And I was, bad news is good. And I think that's right.
When were you saying that?
European 11, European financial crisis.
Why was bad news good during the European financial
because
crisis? I was terrified.
It was a pending accommodation, right? As soon as Draghi said, "I'll do whatever it takes," it was the biggest risk on signal ever, and it was hard to see in the moment because you felt like
2012 was incredible.
Right. And then you started getting all those QE. So okay, bad news is good. I think people think that that's always the case, and I've been arguing a lot with investors. Like, I don't know. It could just be like good news is good and bad news is bad. Like, why does it always have to be good is bad, bad? I never believe good news is bad sustainably. It could be for like 2 trading days, but I think if the economy's good, it'll be good for equities, and I think if it's bad, it won't be good in a linear line toward the accommodation. And I think that's where like.
What if you were right though? What if you were originally right as a young man, and bad news is good in a crisis? Outside of a crisis, bad news is bad.
That's what I was going to say.
I think that's right.
That's fair.
That's right. That's I think what we're saying. The same
Bad
thing.
news is good if you're in a bear market and the market rallies on bad news. That's when it's good.
Yeah.
Outside of that,
Yeah, I think if you have a problem, they need to stop it. Sure, but if it's just sort of like things are slowing from the highest nominal GDP in our lifetime, and why would they do rapid fire?
Well, there's one reason why they would do it because they claim that their target is 2%, and if you do get to 2% this year, which who knows?
Yeah, but you need full employment. You have to have an unemployment problem.
if they cut 6 times with full employment,
Yeah, we have pretty good employment.
and then they're going to create another bubble. The markets, the IPO window is going to open wide up,
Right.
and asset prices are going to go nuts, and we're going to be right back to where we started.
Could be.
I'm positive.
I'm
just kidding.
I know it could be. I just don't know how to calculate what they do. I know that through my career, I haven't found economists all that helpful in terms of. I think it's good to see where I am and understand, but in terms of predicting anything, because I think the stock market predicts the economy and not vice versa. So you'll find out, in 4 or 5 months how the GDP was last year.
Well, if the stock market's predicting the economy, we're not having a recession this year.
Right.
Let's talk about the consumer.
And if it's predicting it in China, they might be. And I think those are the ways I look, and that's kind of consistent with how I think about it.
So the consumer is the economy. It's 70% of nominal GDP.
Right.
Adam, you wrote in aggregate, the magnitude of the consumer slowdown will likely be the key macro story for this year. As short of a precipitous economic collapse, industrial activity appears to be close to bottoming.
Right.
What are we looking at here?
So these are the other 2 gauges that you guys pulled out, and we have a bunch of these. The consumer one, anticipating Josh's question, is more like wages, jobs, retail sales, credit card delinquencies, consumer confidence, like consumer-related stuff. And the industrial one is more, on the right, is more a combination of activity, industrial production, ISM, rig count, auto SAR, and then also logistics like dry van rate per mile and stuff that's getting moved around, kind of trucking and cost. So I'm trying to isolate the industrial part of the economy on the right and the consumer part on the left. There's no question. If I gave you the job right now, go back to your desk and tell me how the consumer's doing, I think you're going to say decent shade, absolute return, but declining. right? You're seeing that from, slow pickups in 90-day credit card delinquencies and that kind of stuff. I don't think it's collapsing. I just think it's slowing from like a pretty hot rate.
Bank of America showed that their spending was 10% year over year in 2022, 4% year over year in 2023. I think if we get that again in 2024, that would be pretty good. So the consumer is fine. I don't think anybody would say they're on fire, but they're fine.
It's just not 2021.
It's fine. It's fine. Yeah, that's right. Yeah, that's right. And that's my view, and that's why I think I'm directionally positive. But
there's no divergence here. It just looks like it's degrees. These look like the same chart.
Maybe said another way, like it was at an all-time high on this. These are normalized scales, so think of them as like Z scores or whatever. So, you were at like an all-time high when they pumped all the money, into the economy, on the helicopter money post-COVID. So the consumer was on fire and they were spending like crazy, and that's why inflation went through the roof, and that's why it was.
What's concerning about this chart is it never ends other than in negative territory.
Yeah, and the
so that's
what do you mean?
Well, it doesn't stop short. Once it's going down, that's it. It's going negative.
A couple in like 2011 to 17.
But this is only to 96.
Yeah, a couple 11 to 17, and this is only 96, right? Because we didn't have all the gauges. But I think it's hard to tell because, I don't think – I think about the consumer like as an income statement. So the revenue in that analog would be number of people working time, number of dollars per hour. Like the wages times employed total is still pretty good. So – just savings they can make. When you add it all up, year-over-year personal income growth, some of it looks okay to me. I don't see the consumer as likely to tank.
This might be a dumb question. Yeah. Does spending drive the economy, or does the economy drive spending? In other words, if the economy slows down because people are getting laid off, then obviously they'll stop spending. Absent that, they're not going to stop spending.
Yeah, it's probably access to borrow is like number one. Like demand for loans, like their ability to borrow, because like so many people live on access to being able to borrow.
But we saw consumer credit pull back, right? And still the economy powered on.
The richest group of people, which drive like half the total spending, are
I said that on TV today.
Inelastic.
I said it on TV today. Yeah, okay. There's this really perverse thing going on where this rapid increase in interest rates after 15 years of zero rates, all of a sudden we now have a third pillar to the wealth effect.
It made inequality worse?
No, I'm saying it's defeating the Fed's purpose. Yeah, housing is really important for the wealth effect. Obviously, it's the most important asset to the most households is the value of the home. Okay, that's one. Two is the stock market. We got 401ks at record highs again. Okay, now you got a third wealth effect. Holy shit! I have $200,000 in the bank, and look how much income it's throwing off. I feel rich because of my home. I feel even richer because of my stocks. Right. And whoa. My bank is paying me.
If you take these high net worth individual guys,
so now you take that upper income, not even the top 10, the top 30.
Tightening was stimulative.
The only way they can slow the consumer down is by cutting rates. I'm convinced.
If you think about the big networks of the big private networks that have, $2 trillion plus like that group, the few of them. I think they report this data, the average financial advisor is mid-60s and their average client's late 60s, something like that. And so there's a lot of folks in that cohort who have $20 million, right? And they spend, $400,000 or $500,000 a year and don't want to dig into the principal and live for the rest of their life. And so all of a sudden, they kind of might have benefited from the greatest two-way street ever, right? For the 20, 30 years they needed to accumulate wealth, the stock market was basically a monster. And now, they're able to like kind of capitalize and live off the interest-bearing portion of the principal without taking much risk. So like they might win. You might look back and be like,
this happened before.
Yeah.
If you watch Smokey and the Bandit, or you watch Cannonball Run, I forget which one it was.
Or Bone Tomahawk.
No.
You watch Burt Reynolds.
You watch the Burt Reynolds oeuvre of the early '80s. All right, Cannibal.
How do you spell oeuvre, by the way?
Who do you think is listening to this podcast?
My grandparents.
Smokey and the Bandit.
The point I'm trying to make is in the early '80s there was a wealth
very fancy.
Is that a tilde on that? Okay.
Yeah, stop flexing on us.
There was a wealth boom in the early '80s.
Yeah,
and interest rates were at 20%. Right. So it should not be lost on anyone. We had Lifestyles of the Rich and Famous came along in the early '80s. We had this massive boom in obscene wealth.
I remember this guy maybe 15 years ago. He tried to pitch me on whole term insurance. Okay, and he was using the whole trailing performance of long dated bonds argument, where it was like locked in from 80 to 2010, as if that was going to be the go forward return. And it was like he didn't realize that like he was brushing back the pile of leaves with like the deepest hole in the least possible when he was pitching me that product.
Yes.
I'm like, I'll buy term, get out of here.
Yes. Right. Give me 20 year term.
Get out of
So
my
wait, what was
face.
your point?
My point
No,
is.
I get it. It's like it's a rate. It's the rate
My
environment.
point is, it's not a guarantee that you could slow the consumer down, especially the wealthy consumer, just by raising the rate, the level of interest rates.
You can slow the low-end consumer down when you don't give them access to borrow. That's why I said
100%,
that. You
yeah.
have to give them access to credit. So if that dries up, financial conditions tighten a ton, that's why things slow, because then they can't access it through, credit cards that tighten up or have bad vintages or through, home equity borrowing, that kind of stuff.
No, it's funny. Paradoxically, I made the joke earlier, but I think I'm turning serious on this. If the Fed does ease and they lower rates, people who have money in money market funds are going to feel like they're tightening. It's like, wait, what the hell? I was getting 5%. Now you're giving me 4%.
Yes, that's my point. Wait, by the way, when you see news, they're going to open a Louis Vuitton hotel on the Champs-Élysées. It's literally shaped like a Louis Vuitton.
What the hell are you talking about? You're dropping these names. Nobody knows what you're talking about. On the who?
Adults are speaking. Adults are
On the what? Sorry, I didn't remember my suit today.
I know exactly what he's talking about.
So when you hear that hotel is it's not even open yet.
They're
and
building
it's-
a massive new hotel
We have an audience.
store.
It's full for 6 months.
This guy's talking French.
Champs-Élysées is like the Fifth Avenue of Paris.
Yeah, I'm sorry.
Connecting from the Arc de Triomphe down.
Unbelievable.
It's
There
where
we
all
go.
the fancy
There
stores
we go.
are.
Look at this.
Yeah.
You hear that this is like booked 6 months. 6 months.
Duncan,
you know
you
who
have
this
any idea
is?
what he's talking about? I'm sorry.
He does.
I know the brand. I've never heard of this hotel.
It's new. It's new.
It's new. That's why
Yeah.
you haven't heard of it yet. You shouldn't have heard of it yet.
Well, this stock is like one that a cult stock that a lot of people follow and pay attention to.
My
so
point is
it's
the
on
people that are booking this hotel,
right.
they are not borrowing money.
Correct.
Okay.
And that's a big driver. And then
This
the rest
is
is borrow,
important.
the rest is access.
This is important distinction. The people that are filling up the Caribbean
I have
are not borrowing money to do
I
it.
have a friend that we send each other the most absurd CPI things from traveling around the country. I travel a lot to see folks, and we send each other funny stuff. Pistachios are $19 at O'Hare or whatever. He sent me one the other day. This was at the St. Regis in New York. Hand squeeze 100% pure Valencia orange juice, $25.
Stop.
Where?
St. Regis in New York.
Oh, you're kidding me.
55th and 5th. Hand squeeze.
For what, a gallon?
No, I think it's just an OJ for breakfast, $25.
Oh, that's amazing.
So that's the current CPI leader in the that's the CPI leader in the clubhouse.
We have to eliminate people that pay $25 for an orange juice. Now, not your friend, but whoever's
Besides
doing it.
him.
He did not get it. He did not get it.
Unbelievable.
He just photographed the menu.
Who is ordering that? That's
Holy
a corporate.
shit.
That's an expense account
Disgusting.
item. You're not paying for that yourself.
I mean, when you factor in, and I wrote this back to him, when you factor in the 20% gratuity and the 8.875% tax, you're around 31.
How
and
could you be
change.
bearish equities if mother are paying
Right.
$25
So
for orange juice?
you're in the $3 to $4 an ounce range.
Time out though. Valencia.
It's like gas. It's
Does
like
that
gas.
mean it's not for? Does that mean it's from out of
What, per gallon?
overseas? Valencia is Spanish.
I
Is that why it's
I think
so
it's a
much?
region in California and in Spain.
Where's Valencia? Is that orange from California?
Let's
or from
bring it
Spain?
back. Let's
I think it's
talk
just a
domestic.
kind of orange. I think it's just a kind of
Oh,
orange.
it's just a type of orange.
But I think
believe so.
originally from Spain, maybe.
I don't know originally. but
Good.
yeah.
Yeah, good work.
All right, so Adam,
let's shift.
Adam, dovishness. This is a good chart. Dovishness
Yes.
means higher price to forward earnings ratios, particularly for growth stocks. I was a little bit confused when I first looked at this chart, but explain it. Explain
All
it.
right. So the left chart shows the black staircase is just the Fed fund futures. Right? I'm sorry, the Fed fund rate, the front end. And so it moved in March of 22 and kind of staircased up. And then the other lines, FF12, 24 and 36, those are Fed fund futures 12, 24, and 36 months from now. How do people see and perceive rates 1, 2, or 3 years in the future? And what you saw is they were very anticipatory of the first initial movement of the front end. And I think that really mattered. The right side shows, for those statistics geeks that are listening, so the statistical relationship or T-statistic between the price to forward earnings for growth stocks and the perception about rates. And it was highly negative, meaning when people thought rates were going to go up, multiples got killed. And you saw that in late 21, all the way through 22, et cetera.
We lived it.
Right. And then earlier this year, around March of a year ago, it stopped mattering. The relationship changed because people thought, all right, we're probably closer to the end of the cycle than the beginning. And so it no longer mattered and people got incrementally hawkish. So it just was a way of kind of, statistically dimensioning that perception about future rates can meaningfully impact the multiples for companies,
So
particularly growth stocks.
In the end of 21 and 22 especially,
Yeah.
when interest rates moved higher, growth stocks got
They get
killed,
killed.
and vice versa. Do you think we're past that, where interest rates are not the single biggest driver for equities?
The relationship is still statistically significant and negative today because those black dotted horizontal lines on the right side are the band of statistical significance for those of you hearkening back to your stat 101 days. But so it still matters. I think if they got much more hawkish and kind of came out with a clear hawkish message, it probably wouldn't be great for equities in a couple month view.
But it's always changing which stocks it's hitting. So on the recent rip in the 10-year,
Right.
utilities have gotten destroyed over the last week and a half or so.
Exactly. This was the growth universe. When we do all the risk work for people, that's where we're really careful. We look at the correlation of every stock to a Fed fund futures, because what I don't want people to do, especially hedge funds, is be long, growth stocks with a negative correlation to interest rates, short melting ice cube, utilities, slow growing stuff that has a positive correlation. And then if somehow rates move the wrong way, they get crushed on both sides of the book.
We say those correlations are not static.
And we talked about that when I was on your show a couple years ago. And the reason I just remembered as I was talking live is I used the phrase Texas hedge. And that's what you titled my edition, because you're Texas hedged if you're kind of have
Meaning
that,
you're doubling down.
Yeah, you have that outsized, bet.
You're putting on an exposure in the wrong direction,
Right,
both sides of the book.
So I think you have to, when you make that point about utilities, you have to be careful that in your portfolio, you're not exacerbating that rate bet all over the place. So if you don't like utilities because a lot of them are indebted and they're exposed to refinancing risk or whatever, then maybe you have to own staples that maybe also trade around rates but are cheaper or have less negative out. Well, you have to kind of be balanced about how you think about beating the S&P, because otherwise you're just making a huge interest rate bet, and if you're right, great, and if you're wrong, you kind of get annihilated.
There is a universe in which we have almost no rate volatility at all this year. No cuts, and not a lot of movement as a result, at least in the 2-year.
We've seen some volatility early on.
It would be bullish for equities if they did nothing and just kept threatening for accommodation in the future, I think, because then you would just that means the data are good enough economically that they don't need to do it.
But how about this?
And you can dream to the next move's accommodation.
Right.
To my point about the correlations not being static, they change. So here's the 10-year ripping higher. Here's XLK ripping to an all-time high.
And what's XLK?
XLK is the technology ETF.
Oh, okay.
I was talking,
or the Qs, basically similar exposure.
I was talking to somebody.
Same chart. Sorry, here are the Qs.
I was talking to somebody who was saying that if you have that push and pull,
right,
and we had massive rate volatility over the last 3 years.
But sorry, that
we
chart I
forget.
showed was a rolling 6-month window. Between the relationship and multiples, it can change for
Yeah,
sure.
that's what I'm saying, it
I think the
changes.
problem is if I do a 1-month window, then I just get a lot of spurious stuff. So I'm not sure what the length is. For sure, it changed. And a year ago, the right call was we're close to the interest rate cycle ending, and therefore I should be bullish on equities. Everyone else thinks it's down the first half and maybe up in the second half, so you should be up in the first half. That was the correct call, and part of it was saying that we're toward the end of the interest rate cycle. I think we're in that same period now. You can't argue that we're likely to hike way more than we're likely to cut. So since I like that skew, then I'm willing to wait for them to cut and maybe cut less than what's priced in. To me, that's bullish.
But not to beat the source of death, but in the first half of last year, we saw massive increase in the 10-year. A huge run. And guess what? The NASDAQ 100 had the best first half of the year, I think, ever, as interest rates were skyrocketing. So those relationships are not set in stone.
Of course not. If they were, then nobody would need a cross-asset view, right? And I agree. But that's because in my twisted brain, generally, when the economy is good, the 10-year yield should go higher. It's indicative of a stronger economy. Why was the market good last year?
AI.
One, you had the biggest upward sales revisions of any mega company
so there's
ever
that.
with NVIDIA. Two, the bear case in earnings did not form. All the bulge bracket firms were out with a 180 earnings number, 190, and it didn't happen. Earnings didn't really go down from February to the end of the year.
We had 3 consecutive quarters of earnings declines, and that was it.
Yeah, and it was all in the second half of the 2022 and the early 20. Right. So it didn't. The bear case didn't materialize. And and then also people said we're close to the end of the rate cycle, and so they can dream that the harshest part of the tightening is over, and that's kind of all it took. And then I think as CPI moderated, the margin dream got better again. So I'm not saying it's hard to have a year like last year and say it'll be just as good this year. So, the other day on air, like Scott asked me, "Are you incrementally bullish?" And so I reacted to the word incrementally, like, no, you can't be incrementally bullish because incrementally means I think we're going to be up more than we were last year. But am I still skewed to the positive? Yeah, that that's the parsing.
Yeah, how did he like that response?
Generally, he's loves what I say.
Okay,
Yeah.
agree. Me too.
Yeah.
All right, this is you. If the economy slows but doesn't hit a recession, and interest rates slowly continue their path toward a normal yield curve, we could see materially higher equities in 12 to 18 months.
Yeah.
This is your chart.
Yep.
So this is earnings.
Yep.
You say base case earnings grow to $237 a share, which would be 7.2% growth in 2024.
Mm-hmm.
$252 a share in 2025. It's another 6 and change percent.
Right.
The bottom-up consensus, that
you're
would be
below.
below the bottom-up consensus
Right.
of 245 going to 274. That's a wide gap between you and the consensus. What do they see that you don't see? Do you think?
These are the bottom up? If you're showing this slide, these are the bottom up sell side consensus estimates, not mine. I'm just kind of
Bottom-up is all of the analysts covering all of the stocks.
Right.
This is the sum total
Yeah.
of their
every
expectations.
single one of the 500 stocks.
This is
we
not
take the
you versus other
We take the
strategists.
median estimate, bottom
Yes.
up every
Okay.
analyst, and we say, what'd you get for that company? We add up all 500. We go back and type for it. So it's very, bottoms up is when you take a glass of alcohol and empty it down
Right.
your mouth.
Bottom
All
up
right,
is a jelly bean jar,
Yeah.
and
Yeah.
the guesses of
Yeah.
like thousands of
Right.
people.
And top down is what like strategists do, where they sort of say, okay, the economy's doing this, and so I think earnings will be a few percent above or below. It's like it's not like at the company level. So, we have like a long. So let me answer your question directly. Forward earnings data, meaning these kind of estimates from analysts, have existed since 1978. On average, in January of each year, analysts' bottom-up estimates were 14% earnings growth in the average year, and the actual has been 7%.
Right.
So there's a long path of downward earnings revisions as their second half of the year optimism typically doesn't unfold. Doesn't happen the way they forecast. The stock market obviously goes up a lot during years where there's downward revisions. So the first point I would say is it doesn't really matter if there's downward revisions to the bottom of estimates. What matters is, do you think earnings are going to be higher in absolute terms next year than this year, or this year than last year? That matters more. So I think there's going to be earnings growth in 24.
not as much as the bottoms up
Yeah,
consensus
just not as
thing.
much as the bottom of consensus.
Okay.
And there was not much earnings growth. I mean, it looks like it'll be. We'll see when we get the full Q4 numbers
It's
in.
looking
But
flat,
looking like
right?
flattish year over year. The current is 0.8% bottom up your earnings growth.
But there was a lot of dispersion.
Totally. So that's that top number in the 2023 column for S&P, where it says 0.8. It's the two numbers above the green highlighted 27. That's that's sort of the total S&P earnings bottom up for this year. We still have a little bit for the listeners, a little bit of the Q4.
So all the growth came from 3 sectors: consumer discretionary, communication services, and real estate. That surprised me. And a lot of the losses came from energy, which had a 30% decline in earnings, at least projected for the year. Healthcare, and the stocks there got killed. And materials. All these stocks looks like shit, especially materials and healthcare.
Yeah. So these are the year-over-year earnings growth numbers. So, the estimates, which are almost fully baked here, three quarters in.
We don't have Q4 numbers.
We don't have the
for
Q4
everything.
numbers yet,
Okay.
but they are, they were quite bad. And obviously, the oil prices and copper, et cetera, came down a lot. And I think the healthcare is probably the most surprising, just because you had some COVID hangover stuff on the drug side. And,
Pfizer, Moderna,
yeah,
killed.
but the healthcare services businesses generally have pretty good pricing power. So I think
What are some of those names?
UNH is the biggest.
It's a great stock.
Yeah, they had a little bit of a cost issue earlier this month where they guided to medical costs. But like, I know as someone who has a small business in New York, like they have incredible pricing power over me.
Yes.
Look at this.
What are you going to do about
Intuitive
it?
Surgical looks like at an all-time high. As an
So
example.
Dexcom and Intuitive Surgical, those kind of companies got like a little bit of a weird GLP sell-off, like in the summer, where somehow people were gonna be thin and never need healthcare procedures again.
We said to fade that on this show.
yeah.
We never
It was-
never bought into that narrative.
Yeah, for me, the most obvious one was Brown-Forman and Coca-Cola.
Ridiculous.
Yeah, there was a day, I think, what's the day the bond markets
what? Good for me.
closed up Columbus Day?
Here's Coca-Cola. I'm pretty sure I said there was a screaming buy. Did I not?
Yeah, we
So
all did.
if
We
you
all
look
did.
at that V, we wrote about this on
Nonsense.
October 7th, which was the Columbus Day. That's the bond guys don't work and the equity guys do. That thing traded below 20 times forward at Coke. And you looked at it and you're like,
Should have bought it. Damn.
like that's a pretty good brand. And then they put up like 10% growth constant currency. Like it's not like it's a shrinking company.
Yeah.
And then the other one that I think is funny is Brown-Forman. So like I wrote this thing about Jack and Coke. Like you're telling me that, there's going to be no Jack Daniels and no Coca-Cola consumed. Like you want to bet against the U.S. consumer, go ahead. Don't bet against Jack and Coke.
The U.S. alcoholic. Don't do it.
As if Coca-Cola hasn't adapted before. Diet Coke. Literally. Coke Zero. They sell water. Like it'll be fun. Coke Zempic.
It's coming.
Yeah, they could put it right in there and then tighten it up for your
Adam, let's talk about where the earnings growth is going to come from.
Yeah.
You have a slide. The biggest companies have strong earnings growth.
I love this. Let me just read this for you, Adam, or for the audience.
Yeah.
The biggest 20 companies in the S&P 500 have significantly higher net income dollars and earnings growth than in 2020. Any pre-COVID comparisons are silly. I don't think people know this. So a 10% miss in 2025 earnings expectations would still yield 2x the net income dollars in 2025 versus 2020.
Yeah.
Holy shit.
And that doesn't count the buybacks. So if you go get earnings per share, it'll be even higher. I think.
Wait,
I think
what that means?
I think what was happening is people were saying 6 months ago, COVID was a weird thing. It was a bubble. Government stimulated in. Let's just pretend it didn't happen. We'll go back to 2019 and we'll compare earnings to 2019, and that's how we'll get. I think Q4 2019 earnings were $43 a share for the S&P, so you multiply by 4, 172. So people are throwing a 180 earnings number out when they were bearish in the middle of last year, and hey, I'm negative on equities. Earnings are going back to 180.
Now with $25
so I took the biggest 20. Yeah, I picked the biggest 20 companies. I said, okay, well, here's your 2018 net income dollars. How much net income dollars they earned. Here's your 2020. I have every year, but I couldn't fit it in the chart. And I said, all right, these are the biggest 20 companies, Apple, Berkshire, JP Morgan, whatever. Here's their net income dollars, and here's what the analysts think it'll be in 24 and 25.
Holy shit, look at Apple.
So it's $796 billion in 2025. And
that's the net income dollars of the biggest top 20 companies
combined.
Okay.
So 0.8 trillion.
This is why you own stocks.
And then you look at the 2020 numbers, there were 382. So 382 times 2 is 760. So if they miss by like a decent amount, it's still twice as much net income. You can't get these companies back to 2018,
Wait a minute.
2020 numbers.
How is it possible that are they the same 20 companies?
Yeah.
Okay.
Yeah.
So how is it possible that these 20 companies have gone from $340 billion in profits a year to $800 billion?
They're really good.
Because it's a 5-year growth rate.
In 5 years.
You double, like it's 15% per year for 5 years is how you do it. These companies
but they were already gigantic. It's really incredible. Come on. I mean,
pricing, power, moats, technology, acquisition.
I'm blown away by this. Apple, forget about Apple. Let's use Home Depot. So Home Depot was $11 billion in 2018, $13 billion in 2020, and projected to do $16 billion by 2020.
Actually, do you know what's the one that's crazy? Visa, because that's literally spending.
Yeah,
that's actually tracking the economy. 11.2 billion.
They grow 15% per year
to 20 billion.
Visa grows 15% per year. Yeah,
it's not a conspiracy.
I think the one that you want to look at is Nvidia.
No, it's not. Listen, consumer spending at Bank of America was 40.
Wait, where's Nvidia?
Nvidia
Give me the number.
2018, $6 billion to $60 billion. So it's
$6 billion to 60. Yeah, it's normal.
Consumer spending at Bank of America was 35% higher in 2023 than 2019.
So look,
we spend more money every year.
I guess the point is like these guys are so big that even if they miss by a ton, you're gonna have way more earnings. It's hard. So the bull case is all right. Not these guys, but that's why I said at the beginning of the show, like the average company can show some margin expansion.
Yeah,
and nobody's pricing that in, right?
These guys are immune to CPI, right? It's the average guy who sells,
higher CPI. Like literally helps them raise prices even faster.
It didn't matter. It killed the profit margins of the other companies. So to the extent that CPI continues to moderate, you'll see a higher chance for margin.
Chart on. Next one. We got it. Adam, talk to us. We've got your margins chart. There's a great story in here. So we're looking at you said the median company's gross margins have bottomed.
Yeah, so this was part. Yeah,
look at that mega.
So
talk us through this, please.
Yeah, so the left side just shows the median company's gross margin. So you can see. Got killed,
48% was the high in 2020.
Kind of like 42, 43
dropped
at the trough. And so,
40
look, it's
to
always
43.
hard to call like this is definitely it because you can see some squiggles and down previously, but it's not like it just went up 1 month. It looks like it's been kind of flattish to maybe slightly above the
But
lows
the
for 6
right chart
months.
is the more interesting
And then the
one.
right one is the mega cap companies, which are basically on a 25-year trend of somewhat slightly higher gross
Immune.
margins. And the right, it's a little bit pinched in the scale, but margins got killed for these guys. You know,
The non-mega
Yeah,
caps.
the non-mega caps. Do you happen to have the next slide too, or did I?
I don't. Which
Okay.
was that? I don't think so.
Okay, it's okay.
Nope.
The next one actually shows that relationship between CPI and the non-mega cap margin. So you can really see it was like strong and statistically significant. So that's part of the reason why I told you up front. Like I think maybe it's bottomed. Maybe it's bottomed. Yeah.
I want to do something on stock picking with you.
Yeah.
You put out a note on pairwise correlations, and let's talk about the tech sector. So you break it down into like 12 subsectors.
Yeah.
You point out
Oh,
there's
you got that? We just
Yeah, we
did
got
that.
it.
You guys
John,
did that today. You
next
guys
chart.
are
Yeah.
You guys are
this
on
is,
it. This is
I told you
your
this- I told you-
operational improvement.
We come prepared.
I told you this was the best investing podcast in the
You know
world,
what?
right?
When I was on, whenever it was 18 months, 2 years ago, the game was not this tight. This,
Dude,
this is
we're not
elite.
fun- we're not-
You guys have gone.
The listeners and the viewers.
You guys have
demand.
had at least 15% net income growth per year. You guys should be stock 21 on this.
So
Yeah.
you made a really interesting case here that
Yeah.
a lot of CIOs, especially bottom up fundamental focused CIOs, they will tell you, I don't worry about the macro because either it doesn't affect my stocks or even if it did, I can't
I'm a
quantify it.
cold-blooded stock picker. I only do buy my stock picker.
Right. So you said, well, you may not care about the macro, but the macro cares about you. And you're looking at correlations between stocks within all the sectors, but the tech sector in particular.
Yeah.
You think CIOs do need to pay attention because at certain times there's going to be a lot more or less correlation between the names in a given group.
Yeah. So what we're doing here is we say, if I know if like the market's up or not, if I know if growth stocks beat value, if I know if large stocks beat small, and a couple other factors, how much of every stock's returns can I explain? So
Yeah.
if the market rips and growth beats value and large beats small, I can explain like 70% of Microsoft's returns on a given day. Like so you can't tell me you're a cold-blooded Microsoft stock picker and you don't care if the market's up and growth beat value and large beat small because that's
most of what's happening in the
ridiculous.
price.
That's ridiculous, right?
Yeah.
So we measure that logic for every stock every day over time, and we try to help CIOs sort of say, all right, if you were starting a tech fund today, where do you have a better chance of deploying resources to generate alpha, and where is it more of like a macro call or like a risk
Beta.
management call that you want to kind of make the portfolio strategy? So that's kind of what we do. So when we look at it, we say, okay, where is the level of company-specific risk? Did it go up or down? Where's it versus history to try to help people? And then we have it at the name level. So what this chart shows on the left is just that actually the blue line in tech is slightly below the market X tech, the top 3,000. So
That's not intuitive.
tech guys think they're cold-blooded stock pickers, but they're kind of just as macro as everyone else.
But what are you looking for? A lower number or a higher? CSR is
If it's higher,
company-specific
the company-specific risk
risk.
is higher, then that's a place that you want to craft your trade if you're like a stock
More
picker out-
opportunities
yeah.
for
because you
alpha.
could separate yourself from others. But
something is company specific still matters.
Okay.
But if it's like pretty low, so tech is it's half to sort of 70% company specific. So it's not like it's the worst sector. I'm not
so
saying that.
Adam, you have semiconductors and
They're the most macro part of it,
right
which makes
and
sense. They're
semi
cyclical.
materials and equipment. You're saying those are 35% CSR.
They're
or
50%, 52% now.
52%.
So like half's macro and
Right.
half's company specific, and that's in the 35th percentile versus their history. So it's a little bit lower than average. But the point is just that you can't say no semi-analyst would say I don't care about macro at all. I only do
Right.
stock picking because there's a
Macro
cycle.
cares about you.
Now,
Right,
in
yeah.
application software, you mentioned specifically that like that's an area
Right.
where if you get the company right, it's really going to make a difference relative to the other companies in the group.
So we show like 4 or 5 different things like this. Company specific risk is one of them to assess the alpha. And at the summary point of that, building a crescendo of excitement to get you the edge of your seat is that application software is an area where you probably could use a bottom of stock picking analyst because I think last year was a good example where I don't have the numbers in front of me. I think something like 41 of them beat the market by 20% or more, and 58 application software companies lagged by 20% or more. So, like somebody who's a software stock picker shouldn't be able to say, "Oh, it's like a tough market for me to find alpha." Like maybe they were just bad at it because there was tons of names that beat or lagged by 20. Obviously, if the market goes up 40 it's hard to make absolute money shorting stuff, but if you short stuff that goes up less than 20 and you long stuff that goes up more than 60, that's a cocktail for success. So I try to focus people across the whole market, including in tech and specific. We have a tech strategy product, but where they should deploy resources. And a lot of it, I think what was really interesting in the tech part, my own view, is that when I looked at the names that were most company specific, like most idiosyncratic, you look at the names among large caps and it was like Dell, Hewlett, Intel, Cisco, Micron, Oracle. I thought,
Old
wow, these are
tech.
old tech.
Yeah.
The stuff that's the least Shopify, and because rates move and they move. So all of a sudden you're like, all right, everyone who thinks they're, focused on new tech, there might be some use for the old tech because they're a little bit more idiosyncratic. They're doing spinoffs. They got VMware. They're doing deals.
Yeah.
So there's some more idiosyncratic stuff. And they have low correlation relatively to the newer tech. So maybe that's a better tech strategy. Find one or two of the old ones you like that have something idiosyncratic to go on top of. So I think that was a little bit I don't know, novel sounds grandiose, but it was kind of interesting to some of my tech guys who were reading it. Because when I do tech strategy, I don't go in and go, this software stack's in hand. That's too fundamental
they've
for me.
already done
it's
that.
more the
They've
portfolio
already
strategy.
done that.
Right. Right.
You said something similar, banks versus insurance.
You're right.
Turnovers
Turnovers and penalties will kill you.
We got to water down. It's okay. John, this chart, banks versus insurance from Adam. You
Yeah.
guys put this up over the last couple of days, and you're pointing out that this is not just a tech thing that you're tracking.
Yeah.
What do you think is behind this? What's the reason for this? Is a huge separation between the performance of banks versus insurance stocks?
I think. Look, we have some clients that are financials PMs, or if you're a large cap value PM, and financials are a big part of your index. And I think it's hard because the stocks are super correlated to each other, and you just feel like it's a one-way rate bet, and it's hard to separate. So, a lot of times people say, well, maybe I should own a couple of insurers, and they'll be a little bit, defense. And so, it's still a little bit high correlation in absolute terms, but they've come down a lot. I think it's because in that risk-on trade, some of the lower quality banks went up a lot, and the insurance companies didn't participate as much. And so, if you're looking out going forward, you could say, all right, well, maybe I can find some insurance that have pretty good risk reward, and it's not exactly the same bet as the regional bank. So it's a little bit like financial strategy, trying to find, because I'm always worried of just, at least I try to be honest, like maybe you just want to own all of one low quality stock, and if you're right, you'll make the most money possible. But that's not a great risk management approach So I think we try to track these sort of changes in correlation, or when they're changing, say, okay, that could be a little bit of defense. The word correlation is tricky, not to get on my professorial soapbox, but like the problem is like you want correlation when things are good, right? And like you could go up 2% every day, and you could go up 6% every day, and you have a correlation of 1, but I'd rather be you, right? So like it's misleading a little bit when things are good. You just don't want it when things are bad,
right?
And so that's why you have to sort of
everybody wants to be correlated to whatever's going on.
That 2020, the COVID spike, when everything was just going down every day. That's wild. Holy shit.
Yeah, and that was hard to play. It was hard to play defense, and for sure, financials were not the place you want to be.
Buybacks.
Right? Yeah.
John, can you skip ahead? Are buybacks good for shareholders, not for value stocks? Let me read you, and then you'll react to it.
Sure.
We would have guessed that buybacks would be a good strategy for value stocks, as it can often be a meaningful source of earnings per share growth for that cohort. However, there is virtually no subsequent performance differentiation among value stocks for big decreases or increases in shares outstanding over a 12-month period.
Yeah.
What's going on here?
So, look, we could spend weeks talking about this topic.
I am not busy.
do it.
Companies like they want to buy back. Let's go back.
Buybacks. Wait. Can we set the stage?
Yeah.
Buybacks were fairly muted last year because of the higher cost of capital.
Right.
It just wasn't. People were laying off employees. They weren't focused as much on allocation decisions. Or do I have that wrong?
Net 2% buyback for the S&P, something like that. I mean,
Okay.
I'll explain the chart quickly. The group on the right is growth stocks. The middle are a middle zone called neither, and the right are value stocks. We break the market into thirds, and then from left to right, it's your volatility adjusted performance. If you bought back 2.5% or more of your shares, the shares were kind of 0.5 to 2.5% lower, around neutral and gray, and then you start diluting. So at growth stocks, you want to avoid massive dilution, for sure. But if you look at like the right, where value is, the blue bar, which is buying back 2.5% or more, barely does better than the gray bar, which is keeping your shares
not much difference at all,
unchanged.
Yeah.
And so if you think about that over multiple years, like if you're buying back 2.5% of your shares 2-3 years in a row, and you're not outperforming someone who's doing anything, like the by definition, that capital should be deployed elsewhere. Dividend
Unless,
yeah.
but what if deploying the capital elsewhere would be even worse?
It's funny you say that.
if you're losing
I wrote a note on that because the biggest criticism that one thing you could do elsewhere would be do dumb deals.
Exactly.
And so we actually studied that in a note maybe 10 months ago. Of sort of smart, long only PM asked me that, so I'll say that was a smart question. Not that your previous ones weren't smart, but that was one of your better. That was one of your better moments.
I'll take it.
And the answer is. It helped a little bit versus dumb deals, but not that much.
That's surprising.
Yeah.
As I say, back to Disney, like people were taking issue with Bob Iger paying himself $31 million. I'm like, yeah, but he also could have done it, taken that money and bought back stock at 180.
So this was what I want to. This is what I talk about. So when I covered,
what you're saying.
No, this is important. I was a semiconductor analyst, in 2002 to 2006, right? And I covered large cap chip makers. Intel was my most important stock. And in those days, it's whatever, 7th or 8th biggest now, but it was the biggest then. And they bought back $1 billion of stock every quarter. So I talked to their CFO at the time. I was a young analyst, and I said, "Why do you buy back $1 billion every quarter? You're cyclical, and I think you know stuff about the business, and I would assume you could do better." And he said to me something I was so naive I didn't understand. He said, "This is a quote." He said, "Adam, if I back $500 million this quarter, you're going to be an asshole to me on the conference call."
What did he mean by that?
I'm going to say, "Well, do you think the stock's expensive? Is that why I do it?" Like, so he
Why
was
aren't you doing $1 billion?
So I went to my boss and I said,
yeah.
"I don't get it. Like, I thought they did what actually made sense. Like, I don't know. I was 34 years old. Like, who cares what I think? I'm like, like do what actually makes sense." And I realized, like, it's so much of it is a signal to them.
They're selling a story.
And it shouldn't be. If you ask Warren Buffett, does he want a signal or does he want to buy it right? He says, "I want them to buy it right." But so many of these management teams, they're like concerned about, the 2-day market reaction and not deploying the capital correctly. The second thing is when conditions are good and they feel prize momentum, they feel good, they buy it back. And when it's not, they don't. So like they're almost like slightly negative indicators. We then do some work, and a lot of boards and companies are interested now on accelerated share purchases, where you do big block through a bank that seems to be more effective. And so we'll see if
Hang on. Can you explain? That's a type of a buyback?
Yeah, it's
Accelerate, yeah.
So you do a big chunk at once.
Rather than authorize it in January and then slowly buy opportunistically.
The Journal just
you
did an
just
article
do it
on
in
this.
one shot.
Who was doing it? I can't remember. But you're so right. These buybacks are pro-cyclical when in reality it should be the opposite. But these decisions are made by human beings.
There's some more information, and we study this in open market purchases by CEOs or CFOs, because then they're doing it in the open market, and that's more of and then open market sales.
And off schedule, right?
Well, they're restricted on when they can do it, locked up like crazy. They can only do it during the appropriate
Most
period.
tech executives, though, are getting too many stock options to be doing an open market purchase. There would be no need to.
But that's the signal.
I think if you could study the variable compensation, that would tell you a ton. We do a lot of like natural language processing where we're ingesting stuff from transcripts systematically. It's very hard to get a variable comp, because what I mean by variable comp for everyone listening is not what your salary and bonus is, but like if you hit a 15% revenue growth per year target, you get another 10 million in restricted stock, or I'll get sneaky here for the accounting nerds that are listening. Like, do you get the dividend on the unvested portion of your deferred? Do you pay capital gains or do you pay income tax? Like, because remember, if I'm long $10 million of stock with a 4% dividend, and I get $400K per year on the unvested stock that's going to vest 2, 3, 4 years from now, I love myself the dividend, right? I hate options. I don't want to do it. Right? So there's a lot of like tie goes to the runner or whatever. Nobody purposely damages their own net worth. So I think the decision making, especially stocks 300 and below. Most of the top 100 have real boards and real financial. But like as you get into the squishier $6 billion market cap zone, there's some weird stuff. Or like Batnick's your financial guy on your board or whatever.
But when you say the opposite is not true, I would assume that companies that are diluting their shareholders ex Tesla is a pretty shitty place to be.
Yeah, the growth companies showed that 2.5% or more dilution is bad. Those were net dilution numbers. So I could see the merits of a company, paying their employees who are R&D based 2-3% dilution, just buying it back to zero. I could see that.
I'm talking the net.
But yeah, net. Those are all net that I was showing. But I don't think like buying back 2.5% versus zero has been very helpful in a lot of cases. And I think consistent dividend growth, once companies do it 2, 3, 4 years in a row and their payout ratio doesn't get above kind of 0.6, 0.7, meaning like there's no risk they're going to cut it anytime soon, those companies tend to accrue
You and Ben did this on Animal Spirits. I think how stocks went from being wealth creation to wealth generation Or what were you trying to say?
Just the capital efficiency of these companies to what we were talking about earlier about earnings in 2020 versus 2025. It's incredible how ruthless and efficient and just amazing these companies are at generating returns for shareholders. Obviously, they can't control the macro, not every year.
Yeah.
But if you're talking about generating returns for shareholders as earnings per share,
Look, if
they've never been better.
If you're going to be the CEO of a big company for 10 years, what do you want said about when you're done? Number one, you were a good steward of capital. You avoided stupid deals. Maybe you did one or two good ones. You bought back the stock well. You grew the dividend. You rewarded your shareholders, right? Like that's number one. Two, maybe you got a relatively higher multiple on PE, EV to sales or whatever versus your peers or an absolute
No one's going to
terms.
remember you for that.
But it's correlated to stock.
It
going up.
matters, but yeah.
You avoided taking on unnecessary risk. But at the end, it's where you're a good steward of capital. Right? So that's why all the advisory stuff is around management decision making. And I just can tell you that generally the system is bad at buybacks relative to the other deployments.
You've been doing this a long time. You're a student of market history. Have you ever seen a period of time where companies were so good at generating more and more free cash flow?
I mean, the free cash flow yield is not a good way to look at it because the price might be asymmetrically rewarding that. But I think
maybe not relative to the market cap, but just earnings per share. Just the way that they create value and turn these battleships around.
It's funny. I have some data on the S&P that goes back to 1928. So it's 95, 96 years of data. And the long-term S&P return is 11.7% per annum. It's been 13% and change since 2012. It's been 11.8 or 9 since 1972. So like the consistency at which companies can deliver productivity and drive out costs. You're sitting here now, and you're not even in the batter's box yet on AI, right? Like everyone uses it.
Yeah, we don't even know the impact of that.
I know that the ability to look for low net income or low revenue per employees at huge companies, the ability to, think about it. If you can take a business that has 50% interaction required down to 10%, you can fire 80% of the people who do human interaction. Like you just start doing the math in your head about, well, why do I ever call an airline? Well, because I want to fly my wife use miles and I want to pay for my business and I want to sit next to her and I want to Otherwise I would never call, right? So if we get to the point in 5 years from now where I search for London and all of a sudden it says, last time you did this, it goes to Seat Guru. It knows I don't want to be in the men's room. I know,
it says,
that's where we're headed.
It says,
it's not happening now, but it's 5-6 years from
separate
now.
credit cards. You're flying under business.
Boom, boom.
Your wife is
Last
flying
time we stayed at the
personal.
Bonvoy property here.
Well,
Does
I
that
think
work? Its prices.
Sooner than 5 years.
It depends on the business and the application. I think the big financial industries will take longer because you have to run things in parallel. And so, but the point is there's a lot of, so the way I try to think about it systematically is like, where's there a low net income or low revenue per employee and where could that be improved? It might be screwed because it's a call center, it's a dying business, or it might be something that efficiencies. Where am I paying a high margin? Who's earning a high margin off me? If I'm Jamie Dimon, I'm looking at like which software company and which, service company is extracting a lot from me and can I replace them? Can I predict my employees, this wall garden of behavior and my clients, can I predict their behavior and just obviate the need to pay all these people? That's going to be a huge productivity boom for the next decade. So I think we're early days in productivity.
I think the real savings is going to be one step beyond the AI autonomy. And just like anything you can think of where a person doesn't need to do that work. And BMW in Spartanburg, South Carolina, they're going to be the first of the automakers to have humanoid robots in that facility.
Right.
It's their only facility in the United States.
Right.
They have a robot that it's coming from another company, and it's a lease. It's robots as a service. They're not even buying it. But this is version 01.
Is that a REIT?
RAS.
It could be a REIT. You could probably read. You could probably
30
read a
years
robot.
it'll be a REIT. Yeah. But they're going to have a humanoid robot, and they say, well, what is the robot going to do? It's going to work with steel. It's going to pull things out of boxes. It's going to carry heavy objects. We still have human beings doing those jobs after all this time, and there's no need for it.
The semiconductor industry is incredible. Like when I started, doing it years ago, I put a bunny suit on. I went into a huge wafer fabrication facility. There were, dudes wearing white suits.
You were in the white,
white bunny suit, and they're carrying the wafers around. And what do people do? They get their hair on it. They drop them. The yield was not great. Now you look at these companies and their efficiency, like no human being goes in there. It's locked in a thing. It's a machine. It goes in there. Like there's just massive efficiencies that can be happening in every industry all over the place. And obviously the financial industry is included in that, but I would say healthcare is probably the
Josh,
area
remember
I see
in
the most.
Aliens when Ripley goes into that giant like thing at the end where
Yes.
she kills the queen?
I've
Yes.
never seen it.
What? Never seen Aliens.
Wait, what?
I'm not a science fiction guy.
But you know, like that shit's, I don't know if that's coming, but stuff like that for like factories and warehouses.
Yeah. Well, look.
Productivity is betting against that. I don't think makes sense, and I think the answer is the companies that have done pretty good on earnings, yeah, but they can continue to, and I think that's why you end up with an S&P.
But that's the
well.
key. From my perspective, Dow 100,000 comes about because everybody just wants to own the robots and enjoy their lives and not do. Why is there a human being in a Jersey Mike's making sandwiches? Why isn't that a vending machine? Why is there a human being who cleans airport bathrooms? Don't tell me, oh, isn't it great we're providing employment? Nobody should have that job. Nobody. They should have a different job.
No, this has been going on for years and years. I remember Milton Friedman with the whole
forever.
spoons versus shovels. I didn't realize the job program. What's the spoons? I think that's where we're headed. But I think when you look at it systematically, can the big companies who can afford the upfront spend to benefit predict their customer and employee behavior? Those are the ones that are going to do it first, and I think you're going to unroll it. Like you said, now for the next 5 or 10.
So
years.
I guess the question is: have these giant companies in particular already gotten the benefit of the doubt? How much of this is priced in, or are we just getting started?
I think it's
I'd
closer.
say it's the latter.
I think it's closer. We're just getting started, or it hasn't even started.
Me
yet.
too.
Yeah. I mean, obviously, there's some people doing like I bought an NVIDIA GPU out on-prem and AQIX for my business because we're super efficient using it. I guess every 2 or 3 years I have to get a new one, right? Like but like the efficiencies are massive. Like I'll give you a silly example. Just so let's say 10 years ago I said, "Hey, Josh, I want you to look at every consumer and retail company and tell me if there's any stealing, if they're talking about stealing in their transcripts."
Right.
You would go open, Control F, type in stealing, shrink, organized retail crime, security. You type in those words. Then you'd go to Excel and you'd say, on this date I typed it in.
It's a whole day.
I can do that on Quarter now.
Okay.
You know I'm by Quarter. Go ahead.
What I do is I come up with what I think are the terms that are relevant. I search every earnings call, every webcast presentation back to 2011 for 130 retailers. I merge it into my database. I look at forecasted profitability, multiples, returns, estimates. I can create a long-short basket in 2 hours. Mm-hmm. That would have taken you like a month to do 10 years ago.
Yeah.
Okay, so it's nothing I described as AI.
And
It's
you're
just
not. And by the way,
it's just extraction and efficiency.
And you're not NASA. Like you're able to do that.
I paid $10,000 for the GPU. I pay $450
And
a
guess
month in
what?
QIX,
In
and
3
I
years,
know what to look for.
Adam, in 3 years it'll take you an hour.
It's efficiency. My point is, like, I'm a more literate than average person trying to do this, and I think it'll just continue to track down to other businesses over time. So I don't know if it's like eventually, like the pizza guy at the corner's got technology that's productive too, but I already see it a little bit.
No, it's where it really impacts earnings is when people are utilizing AI workflows and don't know it, because the skin over that is an app that they use every day, and that's already here. It's already That's already happening.
I see it in a lot of my life. I don't know if you see it, but like I travel once or twice a year to the same cities a lot, and I land, and the Waze says, "Do you want to go to the place that was the hotel you're, Marriott, Kansas City?" I haven't been there in a year. It's just like it's already like it's
Don't
dialing
get
in
directions
my life.
to Kansas City from him.
Why?
He doesn't know. He doesn't know which state he's in when he's in Kansas.
I thought I was there last week. I thought I was in Kansas. I'm still shook. I've not recovered mentally.
Yeah.
He was in Missouri.
Yeah, I've spent a decent. I've been on. I should estimate the actual number, but I'll just say I've been on 10,000 airplanes in my life.
Not to brag.
It's not a good thing, and it's a huge number. And I've been in 2 tornado warnings at airports in my life, and both were in Kansas City.
Yeah.
It was, I would say, the worst airport in America, and they really improved it a year or two ago. And so it's gone from a bottom decile to top decile airport. So it's been a share gainer in the airport portfolio. But you don't want to be underneath the tarmac at MCI.
I don't want to be underneath any tarmac.
Hey, I want to do one last thing before we go to favorites.
I'm short tornado warnings.
Totally.
Yeah.
You have some stock ideas.
Yeah, we try to generate sector, industry, and stock ideas.
All right. So this first one is long/buy growth stock ideas. And you say the following growth stocks are low growth beta, high quality, low style score, meaning less growth, and have relatively lower revenue growth. Why is that good?
Because so do you want the 30-second answer or the 3-minute one?
Your choice.
I don't know.
I get
most
professorial. I tend to go long. All right. It turns out that when you buy growth stocks, the quartile that works the best, the only one that works over time, is the highest quality quartile. You got to buy high quality business.
Not fastest growth.
What does quality mean?
For us, it's a systematic tag. It's a function of level and stability.
Made in Italy.
level and stability of return on equity and net income, turnover of the share base, distance from default, like quality metrics for the business. And so we tag them high, mid, low quality, and junk every month, and we track that as a factor. And so the highest quality one works. Within the highest quality, what works best are the ones that are lower beta, meaning they don't like ARC is inferior to sort of slower growing but steadier growth businesses.
Yes. Got it.
It might not be the best for a 2-week trade. If you tell me the financial conditions are going to ease, sure, I'll buy ARC triple long ETF or whatever some of your listeners like to do. But I think if you go and you're investing like for a 6 or 12 month turnover or something like that, over time, the highest quality quadrant with lower forecasted growth and lower beta. Why? Because a lot of the fast growing, fast expected ones have higher starting valuations and then they blow up.
You're paying for those.
Sorry to cut you off, but what does growth mean to you? Because I'm looking at Walmart and I don't think of Walmart as a growth stock. So what makes you classify it as such?
Low growth.
So we also have a
It's low growth.
we also have a systematic tag for growth. It is in the growth universe, and it's one of the lower growing ones in the growth universe. It's a systematic tag. There's 4 signals that dominate it. If you have lots of debt, a high dividend, you're cheap on price to book, and you don't grow your value. And if you have sort of faster forecasted 5-year growth, don't have a high dividend, don't have debt, and you're expensive on book, your growth. So like Walmart must be in some cocktail of those 4 metrics just sneaking into the
Well, are these in any particular order?
I think it's just by market cap.
So Visa, United Health, Walmart, Marsh & McLennan, which is insurance, Regeneron.
So we have a basket of these.
Yeah.
And what it shows is that if you held this basket and you recalibrate, I think quarterly, it will massively outperform. Some of the names will change, and some will
But
stay
it's
the same.
the important point is it's the basket, not the individual names.
Right. Yeah.
Okay.
So we own the whole. We buy the basket of like 30 names.
So why don't you make this an ETF?
We have a lot of baskets that our clients trade.
Okay.
You know, the ETF, my understanding, and you're more an expert on this, is that there's a bit of a hit rate issue. So if you start an ETF that doesn't work,
totally.
it could be like
So
a
what?
It can be
so,
a neg-
so it doesn't work.
So start 10. One will work.
Well, if you want to fund all of them, I'll give you some of the
It's
upside.
not that much money. We'll talk offline. Let's do this one other one.
I'll call it JOSH.
These are your value stock ideas. And again, it's a basket. Below we show long ideas, non-financial, mega/large cap value in the top half of quality with high return on invested capital
Right.
and declining net debt. Those are
Those are
that's the
attributes
secret
that
sauce.
work within value. So what we then
Okay.
offer is like a portfolio of the combination of high quality growth and value with the appropriate weights, and then we think that over time can beat the S&P. So it's, some guys are growth guys, they just want the growth names. Some are value, they just want the value names, and then some are core S&P.
So these are your value names: Exxon, McDonald's,
So
Altria,
this is a screen
Colgate.
that
Yeah.
will outperform the value index over time.
What's
Okay.
Packard? Packard? Did I spell it? What is that?
Yeah.
It's capital goods stock.
Trucking. Yeah. Trucking. Yeah.
Do you have fun on the show today?
Yeah, always. I didn't feel like it was time flew by.
Well, this was
It's been
the
an hour and a half.
This was the
Wow.
warm up, and now I feel that you're ready. We're going to turn on all the recording equipment.
Let's do it. Let's do it.
I want to do favorites with you, Adam.
Okay.
We're gonna-
Actually, I'm shocked that it's an hour and a half.
Yeah.
I didn't.
Time flies
Yeah,
when
you guys,
you're in
having
the very
fun.
capable hands of the compound.
Yeah, I agree.
I have a few, so I'm going to go first.
Yeah.
I really want to just make sure all of our listeners get into this season of Fargo, which just ended. It ended this week. Did you watch the finale yet?
Tonight.
Okay, let me explain what happens in the finale. No?
What did you think of the
Are
season?
you in?
I watched it.
What,
Okay.
what did you guys think of the season?
It was good.
I thought it was my second favorite of all the seasons of Fargo. And this is the fifth? Is it the fifth?
I think.
Okay. This is my second. This is my number 2 after season 2, I would say.
Not giving anything away, but what did you think about the ending?
I absolutely loved it. Why? Do you think people didn't like it? I didn't read anything on it on purpose.
It was very Coen Brothers to me. So
It was
I mean, yeah.
extraordinarily
It feels
Coen
so
Brothers.
Coen-y. I love it.
Yeah.
I love the feel.
All right. If you're not watching Fargo, for the love of God, it's 8 episodes. Would you please just watch it?
It's 10.
Okay.
It's 10.
True Detective is back. We saw the first one on Sunday night. What'd you think?
Have not watched it yet.
Okay. Anyone else? No?
Amazing.
You a
Tomorrow.
True Detective guy?
I don't really watch any TV.
Okay, if you were to watch one show,
I haven't watched any of the shows you've mentioned.
I only mentioned two, but
yeah.
if you were to watch one, True Detective, I feel like you would.
I watch
appreciate.
I watch live sports. That's about it.
Okay,
Yeah.
Big year for Michigan.
I'm a Michigan guy.
I know,
It was a
I know.
very big stretch.
Were you in the blue and the blue and maize?
I did the correct thing this year. 2 years ago, I went to the Georgia game in the Orange Bowl. We got blown out. Last year, I arrogantly pinned an LA trip before the TCU game, and then we lost. So I decided not to jinx the
There you
team,
go.
stay home, and
that's why they won.
Exactly.
Are you a Lions fan too?
I'm not. I'm from Boston, but I went to Michigan. So
Got
I'm
it.
Patriots, Celtics, Red Sox, Bruins, which has been a nice,
not
nice,
bad.
life.
You know, it's nice
could do
to see
worse.
it's nice to see the underdogs from University of Michigan finally get one.
Yeah.
You know what I mean?
Yeah, the leaders.
It's
and the
nice
best,
to see
baby.
one thing in life go well for those people.
Yeah, it's
My wife went to University of Michigan.
Oh,
I can't
nice.
stand all her friends. They wear everywhere they go.
It's too much
Michigan.
pride.
It's
Too
way
much.
too much pride.
You
Take
know-
it, relax.
You know, I think when you're
college was 40 years
I
ago.
think when you're top 10 in everything, it's helpful. I had a great time there. I mean, I think if you meet someone who says they went there and didn't like it, it probably says more about them than the university.
Oh no, it's
Yeah.
no question, great school.
It's hard to get. It's hard. As someone who has kids that are college age, it's not as easy to get in as when I applied. I can tell you that's for sure.
It's an amazing school. We toured it for my daughter.
Right.
She didn't end up going there. She's not going to end up going there, but it's an incredible school.
Yeah.
The problem is what you turn into after, I think. is the main issue.
I hear you. I mean, as a Boston guy and as a Michigan guy, we're in the worst quadrant for
Oh
people
my God!
just-
It's you're at risk. You
we're
have
bad.
two risk factors on you.
Yeah, they're the worst. They're the worst. But I raised my kids in New York City successfully to root for the Boston sports teams, and so that was huge. In terms of college, it's been a disaster. They go to schools that are opponents of Michigan. So I've had to swallow my pride.
Well, the good news.
big of you.
The good news is it's fun.
It's awesome.
It's fun.
It's
a fun rivalry.
One of my best moments of my life was my sophomore year at Michigan when we won the national championship in basketball.
Yeah. Did you see they just reunited? Those guys. That's pretty cool, right?
I did. I saw all five of them together. I think it's because the team was 7-9 and needed a little bit of a boost, but they won that game. So yeah.
All right. Well, listen. I know you're not a TV guy. True Detective is back.
Okay, what is
This
that?
is also the 4th season. It's an anthology series, which means that every season has no relation to a prior season.
Okay.
It's a new story. It's new actors.
2 and 3 were not good, so.
Right. But
Yeah.
this one, I think they figured out why those two didn't go well.
What happened
and
to
they
me is
fixed it.
during COVID, like everyone, I watched a couple series. Heist, the one where they were stealing some money, and it just they all turned into soap operas, and then at the end I thought I learned nothing. I'm tired, and I don't because you stay up till 2 a.m. watching stuff when you should have shut it off, and I just felt like empty inside, and so
I'm looking for that feeling. I want to feel empty.
and so I just am like, what am I doing with my life? And so I've tried to, focus on learning stuff, podcast reading, and I like live sports, and I like going to live sports with my kids and my wife and that kind of stuff.
What do you think for the Super Bowl this year? You have a strong take on any of the teams?
The Niners look pretty good.
I mean, all year they have.
Yeah, I guess I root against the Ravens just because as a Patriots fan they've been kind of frisky in our face a few times.
They're fun to watch, though.
Yeah, so I guess even though I'm not from
Make the call.
Michigan, I would love it if the Lions would win. I think that'd be a nice story.
I think
Niners,
that would be
Bills.
fun.
Yeah.
I want to see Eminem like going crazy
More
in
Eminem,
the
the better.
stands.
The more Eminem, the better.
Everyone who is not from Tampa or one of the other competing teams is rooting for Detroit. How could you not?
Yeah, I mean, it's just this, kind of a team that's had. I like that guy the other day who was like 89 and he'd been a season ticket holder for 66 years. And he saw his first playoff win.
Unbelievable. It's unbelievable.
How can you not be a fan of that, right? Yeah.
Michael, you got anything for us?
I
Any best of, or what do we got? No?
I really loved Killers of the Flower Moon.
You did?
I did. I really did. I think there's 2 reasons for that. One, my expectations were thankfully set very low because people did not generally love it.
Right.
And I watched it in like 4 sittings. I think that had I gone opening weekend to the
Ooh, okay.
So-
if I went opening weekend to the theater, I probably would have been disappointed.
Say the
It's so
worst
long.
thing I've said to you so far, which
Please.
is I was encumbered by having read the book first.
Me too.
And
I
so
read
it made it worse.
Yeah.
Because
I agree with that take.
Yeah. It's just the problem was it wasn't I think for all of us of our era, we're like Scorsese, DiCaprio, De Niro, I'm in. Like,
Yeah.
I don't even need any follow-up
Yeah.
questions. And so with that sort of setup, even with, I heard it was long or whatever, it still was disappointing.
So
I thought the best actor in the whole
the
thing
wife
was the woman.
She was
Yeah,
incredible.
She was great.
Lily Gladstone.
Yeah, she was great.
So the book was amazing and different and focused a lot more on the FBI.
I know.
There was very little FBI
I know.
in the film.
I agree.
But I just, again, having low expectations, I thought De Niro was cooking.
Interesting take. I'm
surprised, but I really enjoyed
The
it.
problem is when you get to that level of renown and success as a director in Hollywood, and you have
I'm just happy you picked one thing I've seen.
There we go. Listen, it's not Goodfellas.
no, you have a studio like Apple that's really like unlimited capital and wants prestige. Then you get Marty, and it's like, Marty, what's your passion project? You want to do this?
Right.
Here's as much money as you need.
I've actually seen 2 movies. The other one I thought was awful. It was, and again, it was had me at hello, Paul Giamatti or
Holdovers?
New England School. That was bad.
Sorry, Ben Carlson was into that movie, right?
Yeah, it's a film.
Sorry, I didn't see that
no,
one.
I'm definitely on your team. It definitely sucked.
I mean, I don't. This
No
will be.
offense,
I don't
Ben.
mean this to sound arrogant, but my wife
don't
and I
like
left
his
the movie
films.
and we were like, I think we could have written it better.
You don't like
Alexander-
What are the
Payne.
writers like? What
I don't
happened?
want
Like, give me the script. I'll edit it, and I'll make this movie at least somewhat entertaining. And like, I like Paul Giamatti. Who doesn't? The guy.
Yeah,
I mean,
best.
right?
I think the filmmaker is boring.
Yeah.
Alexander Payne.
Yeah, I
didn't
was
he do
thinking like
Sideways?
I wished I was flying to
Yeah, it's
Singapore
boring.
and
I
it
love
just
Sideways.
killed 3 hours flying there, and then I wasn't as mad about it.
There are 4 funny scenes in Sideways, and Paul Giamatti is the reason for 3 of them.
No, who's the other dude? I'm drawing a blank on his name.
Thomas Hayden Church.
Yeah.
It's just not great. It's
Yeah.
okay.
Good. His knowledge, elite.
Anyway,
knowledge.
Killers is problematic because they make Leo DiCaprio plays the dumbest person in the movie.
Yes.
It's too much time spent with an idiot. The Brendan Fraser character is great. Jesse Plemons' character is great. These guys show up in the last 10 minutes of the movie. It's like, wait, this should have been the movie.
I love Bobby, De Niro, and DiCaprio going back and forth. Again, low expectations. So
yeah.
I was blessed with that.
Too self-indulgent. All right, we're gonna wrap it here. Adam Parker, can we tell people where they can learn more about Trivariate and follow your stuff?
So it's Trivariate, not Trivariate. I should have just called it like T or something. I've had
Yeah, don't start pronouncing things European like.
just-
Michael gets
yeah.
really triggered by that. We
So
learned
it was
tonight.
supposed to mean 3 variables, trivariate, which were supposed to be macro, quantum, fundamental, applied to equities. If I did it over, I would have simplified it because
trace variables.
yeah, we've gotten kind of. I was on the air with an unnamed CNBC reporter who I think trivariated me, so it caused me to
That's amazing.
clench up a little bit. But it's just www.trivariateresearch.com.
Adam Parker Analytics would have been good.
I don't think the eponymous thing suits me. I don't like that too much.
Fair.
I think some people are into it. I don't need that. I like something a little bit nerdier.
We're getting played off.
Yeah, you playing us off?
Duncan's pulled the cord.
What do you got, a train?
It's very subtle. I was just bringing it in.
No, you're right. Bring it up. Let's
nice,
wrap.
good Fargo take.
Adam, as you could tell, we love having you here. We
Anytime.
can talk to you for hours.
Yeah, we'll do it again.
You're one of the brightest, most personable people on Wall Street.
Thanks,
we
man.
appreciate all of your research, all of your insights. I hope that our audience will check out your
Thanks.
site, your service, and by all means, let's not wait this long again before we have you back.
Anytime.
What are you doing tomorrow? Anytime. You said anytime. All right, we'll have you back
I
soon.
mean, I'll come back tomorrow. You watch what you asked for.
All right. Hey, shout out Duncan. Welcome back. John, amazing job as always. Rob, Nicole, Sean, Daniel, the whole Compound Media team. You guys crushed it this
It's really
week.
elite. This is
Yeah.
what your year-over-year improvement is noteworthy.
Thank you.
Yeah.
Wait till you see me in 6 months. Wait till you see me in a year. All
right,
right.
good.
Hey, guys, thank you so much for listening. Leave a rating and review. We'll see you soon.